How do I identify currency exchange rate sensitivity? Are you curious about how currency exchange rates can impact your investments, especially when trading options? Understanding currency exchange rate sensitivity is key to making informed decisions. Let's break it down step by step. First, you need to understand the exposure of your assets. Determine if your investment is directly or indirectly affected by currency fluctuations. For instance, stocks from multinational companies or foreign bonds have direct exposure. Analyze how much of a company's revenues, costs, or debts are in foreign currencies. This will help you see how changes in exchange rates can affect earnings and overall valuation. Next, let's look at currency options. These options give you the right to buy or sell a currency at a set price by a certain date. The sensitivity of these options to exchange rates shows up in their pricing. The intrinsic value of an option depends on the difference between the strike price and the current exchange rate. If the exchange rate moves in your favor, the option's value increases. Additionally, the time value reflects the potential for future favorable movements and is influenced by volatility and time until expiration. Now, how do you measure sensitivity? This is where the Greeks come in. Delta measures how much the price of an option changes with a small change in the underlying currency exchange rate. A higher delta indicates greater sensitivity. Other Greeks like vega, which measures sensitivity to volatility, and theta, which measures time decay, also play a role, but delta is the main focus for exchange rate sensitivity. You should also evaluate market factors that influence exchange rates. Interest rate differentials, geopolitical events, economic data releases, and market sentiment all affect exchange rates. Options that are close to significant events, like elections or central bank decisions, usually have higher premiums due to expected volatility. Keeping an eye on these factors can help you anticipate currency movements that may impact your options or stock positions. Another important aspect is using currency hedges to manage sensitivity. Investors often use currency options, collars, or forwards to limit downside risk from unfavorable currency movements while still keeping upside potential. For example, buying a currency call option can set a maximum exchange rate, protecting you from adverse moves. Selling a put option can generate income but exposes you to downside risk. Understanding these hedging strategies helps you manage exchange rate sensitivity in your portfolio. Finally, when trading options on foreign currencies or stocks with international exposure, calculate how exchange rate changes could impact option premiums and underlying asset values. Use scenario analysis to see how different exchange rate levels affect option payoffs, break-even points, and maximum gains or losses. Adjust your option positions or hedge as needed to match your risk tolerance and market outlook. Identifying currency exchange rate sensitivity involves assessing your investment's exposure to foreign exchange movements, understanding how currency options reflected this sensitivity, monitoring market drivers, and employing hedging techniques to manage risk. This approach will help you make more informed decisions and protect your portfolio against currency fluctuations.